afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and we welcome you so warmly to another Barometer Readings webcast. We are at the beginning of March, heading into spring, and with that, we have a special guest joining us this afternoon alongside David Burrows, our Chief Investment Officer, and it is Amit Joshi, one of our portfolio managers. Amit's going to join us midway through the conversation to talk about the banks. So we're looking forward to hearing Amit's views on the banks. And with that, as always, if you have any questions today, feel free to hit us up on the chat or the Q&A via Zoom. Dave would be pleased to address your questions at the tail end of the conversation. And on that note, David, I turn the conversation over to you. It's nice to see you and great to be back.
Nice to see you. We got a sunny day here today, and it's nice and warm. It seems awfully warm for the beginning of March, but it's welcome. I want to thank everybody for jumping on today. We got lots to talk about. I'm going to move pretty quickly because we want to cover off a lot of things. We're now into first week of March. During the presidential election cycle, we can see some sloppiness in the beginning to middle of March. We'll talk a little bit about what we're seeing in our internal indicators, what leadership themes are telling us, and we'll kind of go from there. So just to kick off from the top, we continue to think we're in a structural bull market that started in 2013. And when we look at the near-term picture, just in the month of January, after being 25 months in this saucer-shaped cyclical bear market, we touched on the 200-day moving average, which is very typical for a correction in a secular bull market, and made a turn off of that in October 2022, and in January made a series of new all-time highs. So since the beginning of the secular bull market, it's been 132 months. The market's up about 236%. We compare that to the 80s and 90s. It pales in comparison both in length of time and in magnitude of the rally. We do think that there's a fair ways to go. We know that it is typical when you come out of a cyclical bear market, you get a nice extended low volatility rally. It remains to be seen what we're going to get, but my guess is that's sort of in the camp of what we're most likely to see. When we look at the near-term picture of the S&P, you can see this series of new highs that we've been making really since the beginning of the year. And the market down a little bit today. This is not going to go straight higher. We can get a 3, 4, 5% correction at any point in time, but at this point, staying well above the 50-day, the 21-day, the 8-day moving average. So we have to give the balance of evidence to the bulls. We continue to be in this new sort of cyclical bull market. We talked a little bit about this over the last little bit, but when the market was higher, November, December, January, and February, you look 12 months out from that point, you're up an average 17.5%, positive every time since 1950. Again, just an indication of what we might expect. And when we look at the Canadian market, despite a sloppy year last year into October, again, by December, we got up and through that resistance, and we've been marching a little higher ever since. I put this up in particular because, like we talked about in all of the recent webcasts, when you have a long sideways period where we don't make highs, and eventually you do, it tends to be you're into a new longer-term bull market. And we look at the TSX, a very different sector makeup than the U.S. stock market. We made highs in 2021. We rallied, we consolidated through the central bank tightening cycle, and we've got 1, 2, 3, 4, 5 solid bars, monthly bars coming off the lows in October. And my guess is we are into an extended period of time where this market could actually do quite well. We've highlighted that U.S. stocks have had significant outperformance over the last number of years. That's waned a little bit. We've highlighted the fact that the Canadian stock market, trading at about 13 times earnings, is significantly cheaper than the S&P 500. And when we look at the near-term earning yield, or the yield of the earnings generated by the TSX companies versus the 30-year bond, we're actually getting paid a very good premium to own equities in the Canadian stock market. But from a sentiment perspective, you wouldn't know it. People have spent the last 2 years relentlessly selling the Canadian market. And so I think that there may be a mismatch between people's expectations, worried about the domestic economy, and then actually looking at the companies that are inexpensive and probably underowned. Remember that a lot of the large Canadian companies are really more global businesses. They're not purely domestic. And we have some sectors that really have come into favor. When we look at global stocks, it's a similar significant discount to US equities, trading at 14 times. We take the global PE minus the forward PE multiple for the US stocks. This is as big a discount versus US stocks as we've seen all the way back to, around the year 2000. So global stocks continue to work their way higher after coming out of very long periods of underperformance. Japanese market is probably one of the best examples. This is the last 4 monthly bars sharply higher. And, it's on the back of the makeup of the market. Big part of the Japanese market is financials and industrials. And financials just continue to consolidate, rally, consolidate, rally, consolidate, rally. And we get into a sharply rising market. You very often get these quick overboughts. You consolidate a little bit and move on. But we got a very clear upward price channel for the Japanese banks. Not lost on Warren Buffett. One of the things that he's been most focused on accumulating over the last year. Indian market up 26% since October. When we look at the Euro Stoxx 50, 1, 2, 3, 4 great bars coming out of this long bear market that the European stocks were in from 2007 through 2024. Mexico coming out of a long bear market, and Brazil looks quite different, but again, showing real signs that it's gone through a bottoming process. A first low in 2015, a higher low in 2020, a higher low in 2023, and now breaking this trend that's been in place since 2008. So when we have one market rallying like the US, that's great. We can focus in that market. When you have a broadening of equity participation in different global markets around the world, all it tells you is that the appetite for equities is getting stronger. You also want to look at the makeup of the underlying indices to see what it is that's driving it. Now, we move from equities to fixed income, generational low in rates in 2020. We saw this long downtrend in rates from 1981 to 2020, move higher, series of little consolidations. I have to say, I think that we're still in a bond bear market. Now, it may be that after bonds bouncing from the summer of last year through until sort of October, this pullback, maybe this is done, we'll see, but we continue to be below all these falling moving averages. And when we look at the size of the drawdown of the aggregate bond index and over the length of time since 1950, since the beginning of the falling interest rates in the late 1970s, this is by far the longest sell-off and by far the deepest. I think this one's quite different than the others and representative of the fact that it is unlikely that there's any significant returns to be had in the bond market in the near term. When we compare stocks versus bonds since the bottom in rates on a relative basis, stocks clearly outperforming. Even during the bear market in 2022, stocks and bonds both fell roughly the same amount. And then as things started to improve from October of 22, stocks once again started taking the mantle. So I would have to give stocks the edge, a significant edge over fixed income. And we think that we're seeing small bits of money leak out of the bond market and finding their way into stocks. And in many cases, finding their way into dividend growing companies. From the bottom of the market again, prior to the bottom of the market, you saw dividend growth stocks start to outperform high dividend paying stocks, and that continues. So for an income investor, we tend to continue to focus on dividend growth, and dividend growth in the last rally in yields or bear market in bonds that happened through the 50s and 60s, significantly outperformed. Stocks went up 15% a year between 1951 and 66, where bonds basically met inflation. And the companies that led were dividend growers. So is that lining up? Well, since March of 23, the equal weight S&P up about 20.5%, the TSX up 14.7%, the aggregate bond index up 1.29%. That's basically over the last year. Our tactical income portfolio, which is dividend growth focused, up 21%. Our equity portfolio up 29.5%, and our global macro portfolio up 22.4%. So the themes are working, and it looks like this is likely to continue. So one of the things that we're watching is the US dollar. US dollar rallied through 2022 in a flight to safety, ultimately wound up getting overbought. MACDs rolled over, broke trend, and we got a really significant rally starting in October of 22. We saw a lower high in the US dollar in March of 23. When it started to pull back, we got a good sized rally in global stocks. And we saw a rollover in October of 23, leading into this rally we've been in now for the last number of months. So the little bounce in the US dollar looks like it's running out of gas again. And that has significance for global stocks, and it has significance for commodities. So commodities put in their low in 2020. They've had two consolidation ranges during the Fed's tightening cycle, and through the other central banks, we've come up and out of that range, and it's something that we really want to watch. Now, obviously, versus bonds, commodities are outperforming. And when we look at the different areas, it looks as though we're trying to move up and out. These are going to take probably some rate cuts to really light a fire. But copper with quite a bullish look going into 2024 after this tightening range. We've had 4 months coming out of it. We talked about energy. WTI broke out on a point and figure chart 2 weeks ago. The energy producers, bullish percent or breadth models, turned up 2 weeks ago. And we've seen some significant moves in some oil stocks. But this, I think, is probably the most important chart from this camp. This is gold. Now, gold consolidated or went through a bear market from 2011 through 2020 when it finally exited. This price pattern is called a cup and handle. For those that are technically minded, it's a very prolific price pattern. And it doesn't really matter until you break up and out of it, which is what we're doing in the month of March. So the reason that I highlight this is that it highlights that there's an opportunity for a move significantly higher. If I look at the last cup and handle formation in gold that went from 1997 through 2006, when it eventually broke out over the next 6 years, gold rallied 347%. So this is something I think that we have to take note of. It matters what the US dollar does. And certainly it's an asset that's under-owned and unloved. We've highlighted that commodities, as of the end of the year, were the most under-owned since December of 2008. And when I update the chart for energy, it's interesting, again, very underweight on a relative basis versus the other sell-offs that we've seen. So this was a bad bear market for energy, 2014 through 2020. Energy looks pretty good, but people seem to want to fade it. I would say, again, this is an asset that's under-owned relative to the way that it's behaving. My guess is there's opportunity for upside. So we put this chart up before. When commodities start to outperform stocks, it can go on for a long time, and it's very early days. Okay, Bitcoin I'm going to touch on quickly because we've touched on it over the last couple of webcasts. We are long both Bitcoin and Ether, about 11% weight total in our macro portfolio. The reason for that, when you get to the end of a crypto winter, and it has in each case been just before a halving, which reduces supply coming into the market, you've got a very significant rally. Same thing in 2021. And it looks as though we may be about on our way. Certainly, Bitcoin relative to the equally weighted S&P, we have broken out and are moving higher. It looks like there's a measurement significantly higher. So this is another asset that would benefit from a weaker US dollar. So we don't have to be everywhere. We have to be targeted. We have to be realistic. We have to make sure that what we're seeing going on in the market lines up with what's going on in the portfolios, we want to target assets that are being revalued, where people have come to a view that it's in one state, but actually we've seen a structural change that can lead to another. In the case of all these global markets, they are significantly underowned by global investors after many years of underperformance. Commodities significantly underowned after many years of underperformance, but there's been a change in the price behavior. And when there's a change, you have to sit up and take notice. You don't want to wait till you're reading about it in the newspaper. So we're always looking for change in the absence of leadership. And we would say there's pretty clear leadership right now. We have to be willing to be defensive and sit on our hands and have cash in the portfolios. Not today. The top-down view is that there are some significant themes, both geographically and from a sector perspective, that are seeing net inflows of capital. We've been able to find some really interesting securities that are both fundamentally sound and technically sound to use to express our view. It's a living, breathing portfolio. And one of the most important things about running a living, breathing portfolio is knowing when it's time to exit. We're going to talk a little bit today about that, because selling is one of the most important tools that you have as an investor, especially as an individual investor where you're not, managing giant positions that are hard to exit. One of the great things is we're a small manager. We can make changes in the portfolios when the time comes. Now, our view always is that over time in a healthy market, a higher and higher percentage of stocks should be rallying. It means buying is spreading, more and more money is getting put to work. Similarly, though, at some point, while the leaders carry on, some of the weaklings will start to peel away. But generally at that time, people are most focused on the absolute leading stocks. And when Brent starts to deteriorate, we need to be a little more cautious. So when Brent is deteriorating, we may raise a little cash, we tighten up the stops, and we are prepared to go no matter how much we think a company is a great company. So our short-term indicators are all positive. Percent of stocks trading above the 50-day moving average in Canada, the US, and globally has been expanding. Percent of stocks in the US with positive weekly momentum strengthened again this week, and percent of stocks making new highs versus new lows strengthened also. The percent of stocks trading above the 150-day moving average, long-term measure of trend, also extended. Breadth for global markets and the Canadian markets improving. In the US, we've seen some weakness over the course of February, but in very specific areas. So let's talk about that. Now, we know that technology is a key space for a lot of private investors. It's been driving returns, certainly since the low in January of 2023. I will highlight that relative strength, or the performance relative to the rest of the market for these large cap stocks, Microsoft, Apple, Broadcom, Nvidia, and so on, has been waning. Now, the XLK index was down 2.2% today. Not significant, trading above the moving averages, but we need to be looking internally at what's going on. The semiconductor index has been on fire. It's been rallying since September of 2021 on a relative basis, and all the way through the bear market, outperformed. Having said that, Apple rolled over in the late part of the fall. Relative price strength weakened. In December, it took us out of our position and has steadily weakened since then, now trading below the 150 and 200-day moving average. Had a very rough day today, down 2.7%. Now, that is a leading stock, and it's an important one for the NASDAQ. Alphabet also now has broken trend. We exited Google last week. You can see weakening relative strength, now trading today below the 200-day moving average. Adobe, an important software stock, also one of the 5 biggest positions in the XLK, one of the bigger companies in the NASDAQ 100, weakening relative strength. This is software. Pulled back to the 200, rallied to the point where it broke down, and had a very weak day today, down 5%. And cybersecurity, this is the cybersecurity ETF, one of the biggest companies in this group, Palo Alto. We got stopped out of 2 weeks ago. So I will say that tech as a group is losing its crown currently, and not to say that we can't see a pickup, but this is a group that is well owned and not inexpensive. Financials, on the other hand, are marching higher day by day. The XLF is up 30% since the end of October, and even on a difficult day like today, group was higher. If we take it in a broader context, it looks a lot like the global markets we've been looking at. 1, 2, 3, 4, 5 monthly bars looking very, very green. Now, we've talked a lot about insurance over the last number of webcasts, property and casualty companies, companies like Fairfax, companies like Berkshire, companies like Progressive, companies like Intact Financial here in Canada, trading well above all the rising moving averages, and they've been dynamite performers. In the banks, we've talked about JP Morgan has been our go-to name, really going all the way back to August of 2021. But over the last couple of weeks, we've had reports from the Canadian banks. And while most people know we had a very, very small weight in Canadian banks, we've been adding to the positions over the last few weeks. So I asked Amit Joshi to come on today to talk with us a little bit about the Canadian banks. They're all different, and about how things are going in that group and why it is that we added some positions back. Amit, are you there?
I am, yes. Thanks, Dave, for having me.
So give us your thoughts on the earnings period for the Canadian banks.
Sure. Yeah, definitely. The Canadian banks, obviously a very important sector here in Canada, make up a big percentage of the index itself. We got involved establishing positions in the Canadian banks after the Q4 23 earnings. What we saw at that point was the fundamentals of the Canadian banks had started to stabilize. And then from a technical perspective, we did see price action that looked very constructive. So coming into Q1 of 2024 here, the earnings period that just passed, we had a small position, like you mentioned, in the Canadian banks. We actually owned all 6 of the big 6 Canadian banks. And there are a few themes that we wanted to keep our eye on during the earnings season itself. The first was net interest margin. So this is the spread that the banks earn on the loans that they lend to individuals and corporations versus the amount that they pay on deposits. So what we were looking for here was stabilization in that net interest margin, and we did get that from the group on average. But like you mentioned, it is a tale of two cities for many of the banks themselves. Another theme that we were watching closely was credit. So this is the provisions for credit losses. Essentially what this is the amount that the banks put aside for potential loans that may default. Although we've seen an increase in the provisions for credit losses, they are still within those historical ranges that we've seen in the past. So currently we aren't seeing anything that we would describe as a potential credit issue for the Canadian banks. Lastly, it is operating leverage that we're looking at. And what this is the spread of revenue growth versus expense growth. And this was kind of a mixed picture as well for the banks. Essentially, we only had 2 of the Canadian banks post positive operating leverage, while the rest of the group was posting negative operating leverage. So this graphic that you have here, the first column is just the earnings themselves. Outside of the big 6 banks, only one of the banks, which is Bank of Montreal, missed consensus estimates. All of the other banks either met or exceeded the estimates themselves. I think one of the interesting things to see here is in the past, we've seen the Canadian banks look to diversify their revenue streams by either going international or going to the US to get exposure. This quarter, we saw the 2 banks that outperformed the most were the ones that were the most domestically focused. So that would be National Bank and CIBC, who will have more of a domestic presence themselves. And I'd say 2 banks that underperform were the ones that had the largest UX exposure, being Bank of Montreal and TD Bank. Coming out of the quarter, we did make the decision to move on from our position in TD Bank. Some of that has to do with the retail exposure in the U.S. itself, and also some regulatory issues that they're dealing with in the U.S. We continue to like the bank space, and our preference would be towards the banks that are more domestically focused, like National Bank and CIBC. Those would be our overweight banks. And although Bank of Montreal had a difficult quarter, we do see that there are some opportunities as they go through the process of digesting an acquisition that they did in the U.S. that would allow them to pull out some cost synergies that should help that operating leverage that I talked about. So we do see some opportunities where we can see the banks really look at their expense growth and try to dial that back and benefit from some of the stabilization that we should see in the net interest margin, which is the spread that they earn. And essentially, that's the most important part of the story.
Right.
So
the two biggest positions that we have on at this time now are Commerce and National Bank. Both have had very sharp rallies off the October lows. In the case of National, really going to 52-week highs.
Correct.
Yeah. So, okay. Well, thanks so much, Amit. This has not been a big portion of our portfolio. I think that we have a total weight of about 6% across the firm in Canadian banks, but certainly good to see a couple of these really start to outperform. Moving on, the industrial group, continued to march higher here over the last week. The sector's up about 28% from the October lows. We've talked a lot about some of the names here. Defense certainly acting well, transport's acting well, machinery companies acting well. And when we look at the number of stocks making a 3-month high, 46% of companies making a 3-month high, this can certainly go higher. And on a relative basis, interesting, we noted last week, of the 12 strongest relative strength stocks, only 2 are from the tech sector, a significant number from the industrial sector. Materials over the last 4 months have made a nice move out of the consolidation range that they've been in. We talked about Cameco in the past. We've seen a little pullback here, trading now below the 8 and the 21-day moving average, but above the 50-day moving average. That's probably a pretty natural pullback. There was some good news this week for the nuclear power sector. You may have seen Amazon is making a deal to buy a $650 million acquisition, buying a nuclear-powered data center to run cloud business that is situated directly beside the Susquehanna nuclear power plant. We've talked a little bit about the fact that Microsoft has said they would like to power their cloud using nuclear power. We've been very focused and talked a couple times about BWX Technologies, which is a company that produces, manufactures, and maintains small nuclear reactors for the U.S. government, about 80% of the revenue, and 20% of the revenue coming from commercial exercises. And you can see that the market's getting a little bit excited about that. That can certainly pull back at any point in time. But when we look at the Cameco chart, this little pullback, pulling back toward the upward sloping 200-day moving average, probably a pretty good entry point for those that are looking to add here. Miners acting a little bit better. Energy companies acting a little bit better. We've talked about CNQ over the last year, and CNQ finally coming out of this consolidation and making new all-time highs. So my guess is we are into what could be a pretty significant move going forward here. So it's great to see some of these things resolve. Now, a couple of other sectors I'm getting asked about. We do have a little bit of exposure to healthcare, primarily to a couple of large pharmaceutical companies, Lilly being one of them. The group has had a move higher, but I just want to highlight relative strength really not making up any ground, giving us reason to add much more. The healthcare sector is performing well. The breadth is expanding, but not really making gains versus the S&P. The consumer discretionary group also slowly working its way higher. We continue to have a relatively small weight there, again, because relative strength really not picking up versus the rest of the market. A few individual names acting better. In consumer staples, relative strength continues to be weak, even though price is moving higher. So relative underperformers. The takeaway, though, is that consumer discretionary stocks relative to consumer staples are up and to the right. So what does that mean? It means consumer discretionary relative to consumer staples is outperforming. And I take the broader message to be that, in fact, market participants think the consumer is probably okay. Consumer staples, more defensive. Consumer discretionary, more offensive. Offense is winning versus defense here, something just to take away from a market perspective. And when we look at the defensive groups, utilities and REITs continue to have weak relative performance. So the upshot from all of this is that higher beta or more economically sensitive companies are outperforming low volatility, more defensive sectors. And that's been the case since the low in yields in the spring of 2020. So what does it mean in the portfolios? Well, our financials weight really continues to grow, now 26% of total firm assets, relative to the S&P weight at 12%, so more than a double weight. We think the group is underowned. We think that rising rates in general is good for the financial services companies. As I've said many times, we've gone from a world where the borrower was in control to a world where the lender is in control. Our tech weight has come down a little further, a pretty significant underweight now to the index. Our industrials weight continues to grow both organically and through positions. The energy weight is a significant overweight from the index. Healthcare is a little bit more than it was, but still an underweight versus the rest of the market. Consumer staples sort of in line. Materials is a double weight, the index. And we have very low weights in things like utilities and real estate, government bonds, and consumer discretionary. So all of this leads to a point I just wanted to touch on, this global equity strategy that we have launched in December of this year. Because we see significant positive structural change and flows into global equities, we thought it was important that we have some exposure for our clients. One of the reasons is when we look at the MSCI All World Index, ex-US, in other words, outside of the US, there's about 850 companies. And when we look at the sector weights, it makes sense. Financials make up 21% of the index. Industrials, 14% of the index. Technology, a smaller weight, a much smaller weight than the S&P. Materials, about twice the size in the index. And energy and overweight versus the S&P. So what does that mean? It means that the groups that are behaving well are important sectors in the MSCI All World Index. So in our portfolio, which is made up of 40 high relative strength quality names, strong getting stronger, and 40 from the value camp, low priced out of favor, but showing improving relative strength, pulled out of the quality list of securities. The portfolio makes sense given what we're seeing going on from our sector weights. We think this could be a theme that works for the next 10 years. And the portfolio is made up of names, some of you know, some of you don't, but they're all large cap liquid securities. So what are we watching from a risk perspective? Well, we watch credit risk. With higher rates, there is the risk that corporations have a hard time handling debt. But so far, the bond market isn't showing us that they are concerned about the high debt levels. In other words, a lot of companies have debt. We don't have to own those, but the companies that do have debt seem to be able to cover the interest costs without any difficulty, and there's no refinancing difficulty. We're watching volatility, and so far, volatility, or VIX, is in a low range, which tends to be the case during a cyclical bull market. And then finally, we're watching seasonality. And when we look at all presidential election years from 1960, there does tend to be a little bit of a dip in through the month of March. But look at the basis for price, not significant. This looks for a 2 to 3% pullback. Our breadth work is positive, so we think that there's solid shock absorbers in place, and then ultimately the market should rally through the course of the year. The net of it is we think we are in a new cyclical bull market, and we likely have low volatility over the next couple of years. If things get more difficult, we're happy to play defense. But until the pictures change, we think the market looks pretty constructive. So with that, Pamela, if there's any questions, certainly we could try and answer them.
Thanks so much, Dave. And thanks, Amit, for joining us this afternoon. It's always a pleasure to have you. And I'm sure everyone appreciated your thoughts on the Canadian banks. We have one question here. Sebastian wants to know, David, if someone wants to participate in gold, would buying the miners be a good idea? Would you buy GDX or XGD?
Well, it's a great question, and it's a difficult one because on one hand, when you buy a miner, you're getting the earnings or cash flow, but you're also getting the reserves that they have in the ground. And so when price moves higher, certainly their earnings and cash flow should improve, but you also are going to probably get some leverage out of the holdings in the ground. We do need to see the companies start to perform better. It's early days. They still have technically a little bit of work to do, but it will be a more leveraged play on gold. So in our macro portfolio, we own about a 5% weight in gold and about a 5% weight in silver. We have a smaller weight in the producers, and that's a little bit for optionality. We'll have larger positions if the gold stocks start to follow through. But, this is something that is just starting to take place. It's going to take some time. If it plays out as it has in previous cycles, it could be a period of years where these could outperform. So you might have a little bit from the gold miners, but certainly the metal itself is probably the first place to go.
Thanks so much, David. I know you touched a little bit on Bitcoin at the beginning of the conversation that we had. We do have a follow-on question, Dave. It reads, Bitcoin touched its all-time highs and then reversed hard today along with the major US stock indices. Do you consider Bitcoin a risk-on asset? And does it play an important part in your broader market analysis?
I think it's certainly something to watch. I mean, when I look at the market tapestry, I see a lot of assets that would tend to perform well if the dollar was weakening. And frankly, Bitcoin was rallying while the dollar was firming so far in the year. And frankly, gold was holding in remarkably well also. And finally, global stocks were performing very well also. All of those things performing well in the face of a strengthening dollar tells me that there is some real strength in those three themes. If the US dollar was to back off from here, I think it would only add fuel to the fire. So, it's interesting. I'm not a huge Bitcoin advocate. I'm a chart advocate. And the charts show that there's something happening there that we want to be part of. So it's one asset that makes up a part of the portfolio.
Great. Thank you so much. Well, that leaves us with no further questions today, Dave, Amit. Thanks again for joining. And David, I leave you with the final word as always.
Look, we have to remember that when you get into a bull market is steady climbing prices marked by short, sharp pullbacks. And the short, sharp pullbacks shake people out of their positions. If your positions continue to be favorable from a technical perspective, and we use point and figure charts to help us reference that, those little pullbacks shouldn't shake you out. Now, we do think that there are some more significant changes taking place in some of the very biggest US stocks, but that actually just helps to solidify the case for having other sectors that are performing really, really well over the last number of months, but maybe not in the spotlight. So we're going to have pullbacks along the way, and it wouldn't shock me if we got a 3 or 4% pullback at any point. But I think the bigger picture is the important part to keep in mind. It looks as though we've got some running room in front of us. And there's a lot of people who are not positioned for this market move. So thanks everybody for tuning in. If you got questions, please send them in. We'll try and answer them. If you want to have a conversation, instead of sending something in on the webcast, give us a call, send us an email. Happy to jump on the phone. And otherwise, we'll see you next Tuesday. Thanks, Pamela. Thanks, Amit.